Today I'll be talking about market structure shift and why it's very important to understand and master this. I can guarantee you all professional traders pay close attention to market structure shift and they use it to figure out when is the best time to enter the market. Here's the thing, a lot of people look at these charts and they assume that just because it's going up, this will be a good time to buy. So you're going to find a lot of people buying around this level, around this level, around this level, around this level, and so on and so forth, because they're trading based on their emotions. They're not using important terms like market structure shift. So what is market structure shift? Pretty simple. Right now, we have a uptrend. A market structure shift is when the trend starts reversing and it goes from an uptrend and it comes down to a downtrend. It literally means market, the structure of the market, it shifts. And there's only two places it can go. It can either go up or down. So when the price starts going up and then it begins to go down, that point where it begins is a market structure shift. And we're going to be looking at it in a closer look right now. So first things first, we got to understand what a higher high and a higher low is. Since this is an uptrend, what we have over here are higher highs and higher lows being formed. Now what's a higher high and a higher low? A higher high is the highest point of the uptrend and a higher low is the lowest point of the uptrend. And it keeps shifting like a staircase. It keeps going up and down this way. So when it goes up, this will be the higher high. When it comes down for a little retracement, like a pullback, it will be the higher low. And then it goes higher, this becomes the higher high. When it comes down a little bit lower, it becomes the higher low, and so on and so forth. And how do we see it? We see it right here. This is an uptrend. So this would be a higher high, higher low. This would be a higher high, and this would be a higher low. And this would be a higher high, this would be a higher low. This would be a higher high, and this would be a higher low, and so on and so forth. Now, how do you understand exactly what is a higher high and a higher low? To mark them, to find out what they are, you gotta look at it in a deeper sense. So for example, if this is going up this way, this will be the highest high over here, simply because over here there are blue candles, blue candles, blue candles, blue candles. It's an uptrend right here. Once this red candle gets printed right here, over here, that point right there is the first red candle. And once price starts coming down within the range, this is the higher low over here. Let's mark it, higher low. Once price starts coming down between this range and this range, it is still an uptrend. So that's a higher low, higher high. Once over here it starts turning a red candle, that means that's the highest point. So whatever happens in between is inside the range. Now once the blue candles take out the high of the highest high, then a new higher high is formed. And the most recent low would be this red candle. So this would be a higher low. This would be a higher low. It's always the last red candle before the uptrend, which is the higher low. And it's always the first red candle of the highest point before it comes down for a pullback and it continues going up. So if I were to mark it on the charts, you can see that it took out this high. This would be the higher high. The higher high is taken out, so the new high is going to be over here, since that's the red candle. I think you can see through the candles. And then this one would be a higher low. So price keeps doing this, price goes up, and because this was taken out, this would be a higher low. And it keeps going and going and going and going. And why did I not pick this candle? Because this is a consolidation zone. It's a small box. You need to pick the lowest point, not all these other smaller points in between. Technically, you could still call them out, but they're not as significant as the main lowest point of the uptrend. So price keeps going up and it keeps forming higher highs and higher lows. Price keeps going up, higher highs are formed, higher lows are formed, and then it reached this point over here, has just formed. Now, how do you know when a market structure shift is forming? Now, what does it actually mean? What does it actively mean? And how do you catch the best moves? You need to use a combination of market structure shift with a fair value gap. What is a fair value gap? A fair value gap is a gap that has been formed between three candles. We talked about this in another chapter. You'll be able to catch it in the course. I go into fair value gaps in full detail, but for the time being, let's focus on the market structure shift. Since higher highs and higher lows are formed, we need to find a situation where price, it breaks a low, like in this candle right here. Once this low gets broken, that is a change of character. Change of character. Now, when there is a change of character on this candle, it simply means that the character is no longer in an uptrend. It's going in a downtrend. Now that this low has been taken out, you don't immediately enter, because you want to enter at the best possible level. You want to enter at the discount zone, since now it's giving you a clear indication that the price is changing its character and the market structure shift is in the process of being formed, and it's going to be going downhill from here. You need to understand before you execute a trade, is this a good place to enter lower or should I enter in a higher place? You're probably thinking it's better to enter in a higher place. You want to catch more pips. So what would you do in this situation? You would look for fair value gaps. If there was fair value gaps that were formed, that would be particularly where you would want to enter. So is there a fair value gap over here? Yes, there is. It's rather small, but it is present. And here's another one. This is the bigger fair value gap. So instead of trading emotionally, entering with buy and sell signals and using my emotions, I simply add a sell limit order over here in the fair value gap. I put the stop loss above the highs, and my take profit, usually I go 1-to-2 or 1-to-3 ratio. And since this is a massive uptrend and there are bigger fair value gaps over here, in this situation, what you could do is take profit at 1:3 ratio. And then once it reaches here, you take partial. So you can close half, you can take 20%, 30% of your trade, 50% of your trade, and then you move stop loss to break even. So since the change of character has happened and you feel like, okay, there's a possibility that the price is going to continue downhill from here, what do I need to do is I need to look for a fair value gap. And we've already found a fair value gap over here, which is precisely where I put my entry point. The gap that you can clearly see between this candle and this candle. That gap is a fair value gap. Institutions always brings price up to that level. Not always, but 90% of the time. So that being said, 3:1, we just sit and we let it ride. Boom. Price went all the way down. It even broke through all of these highs and these lows. And it's completely come back where? To the demand zone. Now, you're probably thinking like, okay, that's a pretty cool move. And here it did enter. If you look in over here, you're going to see that the fair value gap was completely filled. Pretty much almost perfectly. Small risk, secure trade. Now, you're probably thinking, hey, I don't want to catch only 1:3. I want to catch the whole move. That is almost impossible because nobody ever knows where price is going. Not Warren Buffett, not Elon Musk, not Donald Trump, nobody. Nobody knows where the price is going. However, we trade with possibilities. When there is an uptrend and a higher low gets taken out, it creates a change of character. When a change of character gets formed, we look for a fair value gap. The bigger, the better. In this case, there was a fair value gap over here, and even bigger one over here. We can see it right there. Between this candle and this candle, there is a fair value gap. So price comes in, it was a nice high probability setup, it fills it, and it completely dumps. So by the time it reaches over here, you would have had your 3:1 ratio. So if you're trading with $1,000 and your take profit is $500, over here you could close half. So you could secure 250 and let it run. Once you close half and take your partials, you could simply move your risk to 0, and this becomes a risk-free trade. And you don't even need to put a target TP. You can just let it run until you see another change of character on the upside. Once you see another change of character on the upside, that's where you can secure your TP, close your trade, and then look for another market structure shift that brings a fair value gap, and then you can enter again and secure more pips. If you want to learn more about this, be sure to join our Telegram channel and ask questions. We have an active community with teachers and people who care about your trading adventure.